We're going to talk about navigating financial uncertainty. And since we have only so much we can control, what we're really going to be exploring is financial resilience and how to build up both our emotional resilience and our financial resilience to deal with all of the things that are happening at this time. This is an educational presentation only, and I just want to encourage everyone that I'm not giving individual advice regarding taxes, investments, etc. And I would encourage you to consult your own financial advisors for advice that is appropriate and specific to your situation. All right, so this is a lot of us at night worrying about things. There's a lot of scary stuff. Pick up the newspaper, turn on the news, talk to friends. You hear a lot about inflation. We hear a lot about market volatility. I've been watching it this morning. Another day of up and down. We hear a lot about interest rate uncertainty. It seemed certain that interest rates would be lowered, and then it seemed interest rates, are sort of on pause. So we don't know what's going to happen. Job cuts, we're certainly hearing about those. Dour consumer sentiment. This is the consumer sentiment reports that come out monthly and indicated that people are sort of less inclined to shop, buy, vacation, starting really in late December, early January. And that never feels good when people are pulling back. Chaos and conflict, we seem to have a world full of that. And lastly, if it's not about the markets and tariffs and interest rates and whatever, there are plenty of fires, floods, and storms to take up time on the news shows. So given all of this stuff that we are marinating in every day, how do we protect ourselves? We're going to go through some very practical steps we can take to really shore up our financial resilience. Number one, I'm going to go over a cash flow checkup strategy. Then we're going to talk about debt expenses and how to reduce those. Then we're going to talk about investment allocation review. A lot of people, I'm sure, have some uncertainty and questions about how they're currently invested, and we'll talk about that. Next, we'll turn to where to stash cash. There are places where we can still find yields and keep it safe and sound. And then, of course, I always like to leave you with resources, places where you can learn more and explore these topics further. So a cash flow checkup. This makes sense in a time like now because we can control our cash flows. If we have money coming in, even if it's from a pension because we're no longer working, we could put together a very simple budget or spending plan to just see where we are relative to our essential expenses. When we are not certain about what's going to happen in the economy, will I keep my job? Will there be any changes to Social Security? Is my pension safe? We want to be confident in our ability to cover the nut, the essential living expenses that each of us has. So what are these essential expenses? Our housing, whether we rent or own, we got to pay this. Food, and here that's kind of a very broad category because you can shop in the supermarket and prepare all your meals at home and spend a relatively modest amount on food, or you can dine out a lot, do a lot of takeout, in which case you'll spend a bit more on food. Utilities, we all pay for these: gas, electric, water, and we should also consider access to the internet and our cell phones are also utilities. Many people have cut the landline, so the cell phone is really our only means of communication. That's a utility. It's no longer really optional. Our medical insurance, our prescriptions, our out-of-pocket copays. We want to make sure we have money in our monthly budget to cover all of these. And then lastly, our financial obligations, whether we are repaying loans, credit card debt, insurance premiums. And insurance premiums could be life insurance, disability, homeowners insurance if we own our homes, or disability insurance. We want to stay current with those because if you don't pay for that insurance, it goes away. And lastly, taxes. Tax day is coming up. We have to have the ability to pay what we owe if in fact we owe money. So these are our essential expenses, what it costs to keep the lights on and get through the week, the month, the year as we go forward. If we don't keep a monthly budget, and I believe the current statistic is only about 34% of Americans maintain a household budget. And I'm not one of those budget evangelists, one of those financial planners who says you've got to maintain a budget. There's no way you can keep your arms around your money without it. No, I don't believe that. Most people, if you're cash flow positive, meaning you have more money coming in than you're spending, and it's starting to queue up in your checking account, you're fine. You don't need to count it down to the penny. But in periods of uncertainty, in periods of life transition, it is super helpful to have a written budget so that you can examine it and make decisions with it. It becomes a tool for identifying trends you may want to change or opportunities you may want to take advantage of. So what's a quick and dirty way to do this? Well, I was interviewed by AARP during the, I believe it was during the pandemic, during the shutdown, when people were panicked about the loss of income. This was before any stimulus checks were sent out. And I said simply that you could look at your checking account, look at 3 months, 3 average months, take an average of the money that's leaving the account, and that should represent your total spending. When you look at this average amount, you can take an average of the 3 months, you want to transfer any amounts that were simply money shifted into savings or sent to your investment accounts. That's just a left pocket to right pocket move. That's not part of your necessary spending. The other thing to take note of, if you are paying down credit card balances, what is the average amount that you are paying against those card balances over those 3 months? Just note it, because we're going to talk about credit card debt as its own thing. But if you do this, if you average the total amount withdrawn per month, that gives you a sense of your lifestyle cost. That's the whole amount that you spent. It's not your essential expenses, those are in there, but it tells you how much your lifestyle costs. So when we look at this average monthly outflow and we subtract our savings and our debt repayment, we get our lifestyle cost. We want to subtract our monthly essential expenses from this average monthly number. Then, now that we have our essential monthly expenses, divide our liquid assets by our essential monthly expenses. Now, what, you may ask, are liquid assets? It is all money in non-retirement accounts. So if you have bank savings, bank checking, maybe you have a CD, maybe you have a taxable brokerage account. These are liquid assets because there's nothing stopping you from spending these. No special, tax deferral considerations, etc. These are your liquid assets. If you divide them by your essential monthly expenses, it will tell you how many months you could cover. Now, next we want to divide our total cash holdings, because in truth, we probably don't want to liquidate our taxable brokerage account to cover our essential expenses. How much do we have in cash? When we divide our total cash holdings, including our CDs, by the essential monthly expenses, how many months could we cover? This gives us a sense, a very good, clear idea of how much financial resilience we have. How much could we handle? How long could we exist without a paycheck, right? Without any income coming in, and still be able to keep the roof over our heads and cover our basic expenses. So this is a very important to have knowledge of in each of our respective situations. As we do this, let's remind ourselves what the essential monthly expenses are: housing, whether we rent or own, food, utilities, medical insurance, and our financial obligations, debt repayment, loans, insurance, and taxes. Now, what could we do if we notice that our expenses are high? Well, a couple of moves we could take. If we have homeowners insurance, maybe we own our apartment. Many people are reluctant to shop it given the condition of homeowners insurance in general. It's unlikely we will get a fabulous new deal if we move to a new carrier. But I am always surprised when I'm working with clients and I examine their homeowner's policy, and I'll see that they've got a $5,000 deductible. Home is worth, close to $1 million. They've got a $5,000 deductible. They've got $100,000 in savings, and they're complaining about their homeowner's premium. If you raise your deductible, it will lower your premium. You take on more of the risk. So if you did have, a giant leak or some other damage, you would own more of that out of pocket. But, that is a risk. But month in, month out, as you're paying this premium, you could lower that ongoing cost. It's worth inquiring about. It's something we had a flood in 2014, and we at the time had, I think, a $20,000 deductible on our house. We more than doubled that to keep our premium lower, especially since after the flood, it obviously went up. So something to consider. For food, this is another area where I'm frequently counseling people that, I look at their household budget. It's an exercise I do with financial planning and counseling clients. And I'll notice that they're spending for a couple $1,000, $1,200 a month on the category groceries, which might include, picking up takeout, that sort of thing. But then there's a separate line item for going out to dinner and lunch, and that will be another few $100s. And it can get expensive if you simply don't pay attention to it. And if it's an area that is kind of large in your spending habits, it may make sense to, at least for a time, meal plan, shop, and reduce that to build up savings if you're feeling like you really need to put more in the bank. If you do this, and this is probably more advice I give to younger people who have apps for everything, one of the temptations I do find, and that's the whole premise behind frictionless consumption, is that if you have an app that allows you to order food by tapping your phone, you're going to use that because that's easy. And you're not going to be aware of the cost. First, that it's effectively dining out, and secondly, that there's a delivery charge and usually a tip involved. So if it's Uber Eats, if it's Seamless, if it's Grubhub, maybe you want to take a break, or at least be mindful of how much money you're actually spending in that category. Next in the area, for ways to find savings, if you are paying utility bills, you can ask Con Ed for a free energy audit. They will point out things that you might do to make your home more energy efficient. This obviously makes more sense if you're not in a rental unit. That's really not your responsibility. But if you own your condo, if you own your home, an energy audit can give you some simple things that you might want to consider doing to lower those bills. The other thing you can do, and most of us really put this off as long as possible, you can shop your internet and cell service. Now, I say this, I generally make the recommendation that all of these types of ongoing utility bills and your homeowner's insurance, every quarter, put one under special review and see if there's ways that you can reduce that bill. And I do this on a quarterly basis. This is how I recommend to my clients that they handle it, because if you make this your to-do list for a given week or a given month, you will do everything in your power not to get to that list. It's just too overwhelming and too dreadful. So using myself as an example, My husband and I have been talking about changing our cell service for years because we spend so much on this particular utility. And believe it or not, today's the day. This afternoon, we're going to go to T-Mobile and shift ourselves and our sons to a new plan. And we're expecting to save some money. Next category, medical insurance. If you're on Medicare, if you have prescriptions, Part D coverage, the cost is the cost, and you have copays. But last week I gave a presentation on SHE, and SHE stands for Senior Citizen Housing Exemption, which is a program for reducing home property taxes for seniors over age 65 who own their homes and who have less than $58,399 in adjusted gross income, plus some very valuable additional income reductions. I believe that presentation is on YouTube. So if you're anywhere close to that number, I would encourage you to review the presentation because the deadline for the application or renewal is next Monday, since the 15th is a Saturday. And then lastly, can your loans or debt be refinanced? We can lower the cost of debt. That will help us get out of debt sooner and be less money out of our pockets. So if you're finding that things like shopping, dining out, travel, sometimes other categories are getting a little bit fuzzy, that you know that you spend, but you're not quite aware that you're spending money on these things, and you want to feel more in control, these are two very good money management apps that they're not free, but they're very low cost. One is called Copilot, and it's got a lot of raving fans and great reviews on Apple. And it helps you set a budget for how much you want to spend per category. And then you can see down here that it keeps track of how much you have left. So you know where you are. And if you're going to go over, what other trade-offs you're willing to make. This other, which provides both a laptop or desktop dashboard, as well as a phone app, which is very handy, does the same thing, and it gives you a quick net worth statement so you can keep tabs. If you link it to your checking account, your savings account, so you can see your paychecks coming in or your pension payments, Social Security coming in, and how much money is going out. This is, I have it from my financial planning colleagues, better than the old Mint software because the links don't break. So people have had much better experience working with this, and they do find that it keeps your spending habits in front of you, and you will be more conscious of when you are potentially overspending or spending on things you'd prefer not to. All right, so let's turn now to a debt expense drill down. If we are finding that we have, typically it's credit card debts, starting to accumulate to the point where we're maybe paying a little bit more than the minimum to pull it down, but we continue to put debt onto the cards. And so it's getting a little bit, a little uncomfortable. Then it's time to address this. And the way to do it first is to write down all of the debts. So you make a list, Visa, how much you owe, the balance, $6,000. APR is the interest rate. And if you have paper copies of your statements, the interest rate is usually found on the back. So you can write that down. If you only get electronic, you're going to have to hunt around in the statement to find that information. They don't make it obvious. And then the minimum payment due. You want to know the minimums because the minimums will change based on the balance, the outstanding balance. So just write them all down. No guilt, no second guessing, no beating yourself up. Just make a list. And I've done this as part of financial counseling in the New York Public Library, back when the Science and Industry Library offered financial counseling. That was the branch down on 34th and Madison. I would have people come in, they'd make an appointment, and they'd show up with a paper bag filled with unopened statements. I said, okay, great, we have a project. And we'll open these up, put them in chronological order, and write them all down. Then we're going to rewrite the list, starting with the debt with the highest interest rate. That highest APR is the most expensive. And then we'll list them in descending order of interest rate. Now, I'm going to show you how this works, but I want to explain the two methods of debt repayment. One is called the snowball method. So once you get your list organized by interest rate, descending order, you look at your smallest debts and you prioritize getting rid of those first. It's a psychological win. It's not a fun, you're not saving big amounts of interest payment because you're not focused on the most expensive debt, but you're reducing the number of debts. You zero out those two cards, for example, and that's a psychological win. Hopefully reinforces your commitment to continue paying it down. The next method is called the avalanche method of debt repayment. And that's where you spend the most money paying down the most expensive debt. That's your priority. And you wait on all of the others until you get rid of the monster that is eating up with all of those interest expense. So here's an example. The second rewrite, and we see that the top debt has an APR of 29.95%. I have seen worse, but this is pretty egregious. And typical of many clients that I see, the most expensive card has one of the highest, has one of the highest balances. In fact, it's one of the two highest balances. And whether that was done because it offers points or whatever, we're just not thinking, that is a very common occurrence. So using the snowball method, we would first prioritize getting rid of this because it's only $250, and then getting rid of this to simply reduce the number we have to manage. Now, the most important number on this entire slide is this number. This is the amount of money available in this anonymous individual's budget available for debt repayment. So what we're going to do under the avalanche method is to spend this money, pay only the minimums all the way up for all of these less expensive debts, and put the remaining balance against this MasterCard debt. Now, if you pay $464 against an outstanding balance of $1,500, 3-4 months, this will be gone. What do we do then? We take that $464, we add 15, we get rid of this. If we didn't do the snowball method ahead, before, which I would encourage just to get rid of it. So in that instance, we would take 464 plus 15 and 20, and we'd get rid of this in one remaining payment. So what happens is, as this amount of money gets bigger, these debts start to disappear faster because it's like an avalanche, giant pile of snow, repayment cash coming down the hill. This is the most financially efficient way to get out of debt because you're prioritizing getting rid of the most expensive in terms of interest rate. And it is very effective. Once you get it started, people typically become very committed to continuing and getting rid of all of it. Okay. Now, we have a bunch of different interest rates here. In addition to first deploying the snowball method to wipe out the little debts, could we also consider refinancing any of these? Maybe we don't have $650 available to us to make this debt reduction happen. Let's talk about it. Could we refinance some or all of the debt to lower the interest rate? We would need to have a good and preferably an excellent credit score. And obviously our credit scores, if we've been very good about paying our debts over time, whether these are loans or credit cards, this raises our score. We're also likely to need to have earned income or predictable income. Social Security, pension, this will count. Those are guaranteed sources of income to allow us to qualify for maybe a 0% interest rate balance transfer card. And here, what could that do for us? Well, suppose we were able to transfer this $1,500 to a 0% interest card. Now, it's not free. You would pay typically less than 3% of this balance to move it to 0% interest. But what happens then is you don't have to, it's not growing at interest. So you could decide to divide this by 12 and pay it off that way. And that would be much cheaper than navigating this almost 30% interest rate. That would leave you more money to pay down these other debts and could potentially help you get out of debt sooner. The other option might be what's called a debt consolidation loan. Sometimes you see these advertised as a personal loan, meaning you can use it for any purpose, but many times they talk about it as debt consolidation. And if you apply for one of these, you might get the best deals at a credit union because they tend to have cheaper interest rates. If you're a member, you get the benefit of more generous terms typically than you might get at a commercial bank. And what you do here, debt consolidation loans are 7-8%, and obviously paying 7 or 8% is better than paying 29.95 or even 22.3. So you could reduce these, perhaps even multiple debts at these high interest rates, make one simple payment and only be charged that 8% or so. So that could be a very effective strategy. Zero out these cards and simplify that repayment. You may even have a family member or friend who could lend you the money. Obviously you'd pay them back, but that could help as well. Lowering your interest rate through these strategies will reduce your interest cost and get you out of debt faster. All right. So while we're talking about financial resilience, if you're not in debt, and this is, fairly common to not have significant credit card debt. Many people are in that fortunate situation. In this period of uncertainty, it might actually make sense to increase our credit card spending limits. I meet a lot of people who have a modest number of credit cards and very modest spending limits, and that's fine. However, if you thought that you could experience a loss of income, if sustained market volatility meant that you couldn't pull money out of your taxable brokerage account, for example, or you were worried about a longer period of persistent inflation, having access to a higher credit limit might make sense. Okay? And this is an easy thing to request. If you want to do this, you have to have obviously very good to excellent credit score. Current income can be job, pension, Social Security. It's got to be, reported income. Regular, recent use of your credit cards. The only cases where I hear of people not getting approved is out of the blue. They want to raise their credit limits on cards that they really don't use. It's been months since they've taken it out of their wallet. Well, that is sort of odd in the eyes of the credit card companies, and they worry that, maybe something's different about your financial situation. So they're going to be cautious and say no. But if you use the card regularly, most of us have at least one card we use, whether it's for groceries or gas or, going out to dinner, it gets regular use. You could request to increase the credit limit. And you do this using the automated customer service line. It's all now the phone trees. They'll ask you your current income. They'll ask your rent or mortgage payment. You'll hear some music while they run your credit and double check, and then they'll generally issue the answer right over the phone, followed up with a letter. Now, the potential benefits to doing this, you lower your credit utilization ratio. And just a reminder of what that is. When you have a credit card, if you use up to 50% of your available credit limit, it's neutral to your credit score. If you use more than 50% of your available credit limit, it depresses your credit score. So if you had a card, for example, that had $1,000 credit limit, and every month you went out and you put $750 on it because that's what you spend on groceries every month. Even if you pay it off in full on time every month, the fact that you're using more than 50% of your available credit limit is weighing on your credit score. So if you raise that limit, say you went from 1,000 to 1,500, and then every month you continue to spend and pay off 750, now you're in the neutral zone. And this would stop weighing on your credit score. The other benefit, and the reason I mentioned this in this presentation, is you're creating an emergency spending cushion. If you need it, and think of all the people who have had to navigate wildfires, storms, floods. You want a credit card that will get you on a bus out of there or in your car, fully gassed up, out of there to a hotel, whatever you needed, without worrying about hitting your spending limit. That's a very good situation to be in, part of our financial resilience plan. The other opportunity is with a higher credit limit, you could potentially auto pay more of your bills. Just simplify your life. Put your cell phone bill. They don't charge to have it paid or charged to your credit card. If you're getting miles or rebates, money back from your credit card, why not put your cell phone bill on it? And your internet service, your gym membership, various subscriptions, for example. You don't have to pay these every month. You could simplify. And obviously, having the higher credit limit means that this doesn't undo your carefully managed credit utilization ratio. And as I said, more cash back rewards or airline miles. Let's get to our investment allocation review. I would guess that most of us are here and most concerned about what's happening in the stock market. It's up, it's down. Tariffs are on, tariffs are off. Things change midday, end of day, and it really is nerve-wracking to watch all of this. And if these daily market gyrations are keeping you up and you're worried that they could have an impact on your long-term financial security, we need to really think carefully about how we have our money invested. What we want to think about is, what would we do if we had a 10% decline in our account values, 20%, 30%? Remember that during the great financial crisis, 2007 till 2009, roughly, when the market stopped gyrating on a daily and weekly basis, at its worst, it was down more than 30%. And people who are in the market probably remember that. Fortunately, it all came back. It took a while, and it didn't feel good as we were waiting for the markets to return to more normal patterns of volatility. So how can we protect ourselves? Well, number one, we can lower our exposure to volatile assets, specifically stocks, probably more specifically, technology stocks. These are Magnificent Seven in the S&P 500 are all effectively technology or technology dependent, and they are experiencing a fair amount of volatility. And if you look at the NASDAQ, those stocks in particular have really seen some wild swings. How could we do this? Well, most of us are reluctant, for good reason, to sell into a decline, especially now that the values have come down so much. But we could use our cash flows to rebalance. So for example, if you had a fund, maybe you have like a NASDAQ related technology fund, you can look at how your dividends and capital gain distributions are, your instructions for those, whether you have those reinvested into the fund or have them not reinvested, meaning they will accumulate in cash. You could change those instructions, and rather than having them reinvested, you could have them go to cash, and the buildup of cash from all of your paid out dividends and short-term capital gains will help to dampen the volatility across your entire portfolio. Okay, so looking at the whole account, looking at all of your accounts together, adding more cash will be sort of a calming, volatility dampening move. The other strategy you could use in your taxable accounts, you don't do this in your IRA, for example, but if you had a taxable brokerage account, you could use tax loss harvesting. You sell your losers, hold on to the cash for now. There'll be buying opportunities, but if we're looking to reduce our overall exposure to these, very volatile stocks, you can sit in cash for a little while. You can sell stocks or equity funds in tax-deferred accounts and hold cash. So there aren't going to be any tax consequences if you're doing this in your tax-deferred IRA, right, or 401k or 403b. You'll reduce the volatility. There'll be no tax consequences. You can rebalance individual accounts, or you can look at all of your accounts. So for example, you see an opportunity in your taxable brokerage account to do some very heavy tax loss harvesting, then you sit in cash. But when you look at that account and in conjunction with your retirement accounts, your asset allocation has moved from maybe 80-20 to closer to 60-40. Now across all of your accounts, you're much more conservatively invested. The other consideration another consideration might be to do what's called laddering. People are very fond of target date funds where the asset allocation is managed for us. And typically they are set at a date. If they're used in a retirement plan, the target date is typically when you turn age 65, which is our traditional age of retirement. Not that everybody retires at 65. But if you have a target date fund that is very close in, that's mostly cash. You could take advantage of all this volatility and buy a target date fund that is 10 years out, that have slightly more exposure to the stock equity investments. So that is a strategy for, yes, having conservative money, but also taking advantage of some of this volatility for money that will be managed, the asset allocation will be managed for you. Another strategy would be to add some dividend appreciation funds to your portfolio. Reason these are popular is that they focus on stocks that not only continue to pay dividends, but continue to raise those dividends, have long histories of increasing their dividends year over year. And you don't have to reinvest those dividends into the more shares of that fund. You can have that paid out to you in cash, but you'll be paid while you wait for this period of market volatility to dissipate. Diversification is very important. And I want to do a special call out to anyone who has what is called a concentrated position. And it's something you should talk to your investment advisor about. Who might have a concentrated position? Well, a few people. If you worked for a publicly traded company, I did once upon a time, and I received matches to my 401k plan in company stock. I also participated in a stock purchase plan, which was more of that company's stock. I also had options on that company's stock. When I left, I realized I've got a concentrated position, and I began to sell that off and to diversify this money because things can happen. Fortunes can change for a particular company, and you could see what looked like a fabulous wealth accumulation strategy turn into a bit of an albatross if it went underwater. Probably the most famous example of that, if you know anybody who worked for IBM in the heyday, once upon a time, that was the absolute epitome of the Fortune 500. And if you worked for IBM, you were a big deal and you were very well compensated, especially in IBM stock. Many, many engineers made a fortune working there. Many of them retired and did not sell their IBM shares. And what happened? Well, they were not swift in moving with the times. They were very big into mainframes, and suddenly it was laptops. and it became about the internet and all of that. They have reinvented themselves. They are still are once again a fabulous company. They do consulting on computer infrastructure, etc. So they are very good, but it was a cautionary tale not to keep your giant single stock position, particularly once you retire. So how do you deal with this? There are what are called covered call sales strategy. And a covered call means this is an options trade. This is why you're going to have your investment advisor guide you through this. With a covered call strategy, you buy a contract, or actually, you don't buy it. You're paid to make a certain number of your shares available at a particular sales price. Somebody who wants to buy those shares may, if the market volatility suggests it's a good deal. But when you, working with your investment advisor, are going to set the price that you think is fair and that you're willing to share those shares for. Now, if the market doesn't make them look like a deal, you keep the income from selling that option. So you have the shares, you're interested in reducing your pile of them. It's a fairly conservative strategy for over time reducing a concentrated position. Another strategy would be to set limit order sales. And with a limit order, you enter a sales trade at a particular price. And if the market hits that price, your sale is executed and you obviously get the cash proceeds. That's a way to prevent selling it at a price you don't want to. If the market moves against you, it goes down, and you'd be annoyed that you sold it for less than you could have gotten a few hours ago, for example. Another way to diversify away from concentrated position would be to add index funds. If you own individual stocks, for example, adding index funds gives you broader diversification. Most Americans are heavily invested in the United States. We own a lot of the S&P 500. We're all big raving fans. It's been very good to us for decades, especially the last decade. But we're not the only game in town, and it may be a very good time to really consider some international investments. You don't have to go crazy, but adding a modest position in international developed market companies and their indexes, whether you invest at Vanguard or Schwab or Fidelity, they all have very interesting international funds that you might want to consider. And lastly, and your advisors probably already talked to you about this, you might want to consider alternative investments. And this is an extremely broad category of investments. Their basic value prop is that they are alternatives to stocks and bonds. And in a market decline, they shouldn't be impacted either to the same degree or at all. So these could include investing in funds that are invested in land, real estate investment trusts, whether these are commercial properties, income producing, or mortgages. These are considered alternative investments. And there are, private credit, private debt. These are all out there. And I'm sure your investment advisor, could explain how these work and whether they make sense for your specific situation. So, investment allocation review, we want to manage our emotions around market volatility. Remember, we have been through this before. And what worked last time? Well, stop looking. Stop checking your portfolio on your phone or on your computer. Take a break from financial media. Remember that they are paid to create emotional response. So don't fall for it. Just leave it alone. We're going to get some pretty hairy looking first quarter investment account statements if the trend continues. I mean, it may all turn around next week and the values could all come back. But if they don't, and remember how great our statements looked in December, we're not obligated to look at our account statements for the first quarter. if this trend in volatility continues. So set them aside. Don't worry about it. There's nothing you can do. Let us remember the stock market lessons from the great financial crisis. And the big sell-off really didn't happen in 2007. Toward the end of the year, yes, October got ugly. 2008 was really not a lot of fun. The market volatility persisted until early 2009. It was a very deep recession. The whole thing felt terrible. But if you stuck it out, if you left your account alone, you were rewarded handsomely 2010 and beyond. So we'll have to just, stick to our stick to our guns, get through this, not make any emotional decisions to sell out of our positions right now. Similarly, many of you probably remember, because this is much more recent, what happened during the pandemic. When COVID was declared a global pandemic in March of 2020, there was an enormous sell-off that actually, in terms of percentage decline, was bigger than what happened during the Great Depression, Black Monday. But it was very fleeting. Within a week or two, it had more than regained and then continued to go up when people realized, well, the economy is not going to stop. It's, we're all paused, we're all locked down right now, but we'll get through this. And that is, in fact, what happened. And people who did not do anything, maybe perhaps buy some shares or some funds during that period, did very well, especially beyond 2021. So in this period, when we have little we feel we can control, we want to practice our self-care, take a walk, do some yoga, call a friend. Do not perseverate over the value of your investment accounts. It's not healthy. It's not effective, just worrying about it. And let time take care of this. Okay? We have some strategies for making sure that we are financially resilient during this very difficult time. But we want to keep our equanimity. All right, let's talk now to where to stash our cash. I'm sure some of you remember Scrooge McDuck, the cartoon. He used to like to flop around in his money pile. Periods like this, cash is a great comfort. And I get a lot of questions from people, well, how much is enough? How much should I have? There's a financial planner answer, and the financial planners typically say you want to have 3 to 6 months of your essential expenses in cash safely, whether that's in savings accounts, CDs, etc. You want to have that on hand in case there's a disruption in your income. That's as a single person. For somebody who's got financial dependence, 6 to 12 months, same thing. Essential expenses in the bank, safe, accessible to you. However, for a lot of people, that feels a little thin. A lot of people would like to have a year's worth of savings, 2 years worth of savings, that if something happened, they have it. They don't have to worry about their accounts at all. So there is a personal comfort level, the emotional need for cash. And so if you want to have more, I wouldn't begrudge you wanting to have more than the ordinary amounts. Focus on yield and safety. And I get a lot of questions, where should I put my money? How do I get a higher yield? Well, obviously, higher yield savings accounts, money market funds. And remember, Vanguard, Schwab, and Fidelity are in incredible competition with one another, fighting over expense ratios that differ by a couple of basis points. Their money market funds tend to have very competitive yields. Another option that I think is very good are floating rate treasury funds. Now you can buy treasury bills. It's easier if you buy an ETF or an index fund that invests in treasuries, because then you don't have to worry about, well, it's going to mature. What do I do next? It takes care of that for you. And some of these floating rate treasury funds, especially the short-term ones, and there are a whole bunch of them. iShares has them. Wisdom Tree has them. What's nice about them is their share price will vary by a few cents. Even in the most volatile markets, you'll see it move up and down 3-4 cents per share. Meanwhile, you're getting a nice yield. This is a great solution and a complement to money held in money markets, money held in the bank. Higher safety, obviously, you want FDIC insured accounts. These will be your high yield savings and your CDs. So you can have cash in the bank. You can keep cash in your taxable brokerage account where you can access it anytime you need it. You can buy CDs in your brokerage account. Remember, though, the funny little quirk about buying FDIC bank issued CDs in your brokerage account, that if you look at your statement, you're going to see it. They almost list it like a bond. So they'll have the name of the bank, the interest rate, and the maturity date. Say the maturity date is 2 years out. When you look at it, if you looked at it in a month or two, you might see the balance was below what you put into it. It's priced like a bond. So your intent is to hold it till the maturity date, but the value could go up and down depending on where interest rates are at the time you happen to look at the account at the CD value. So just know that and don't be shocked by it. They work the same way as regular bank CDs. So further thoughts and resources. If you want to learn more about investing, good strategies, really good information, morningstar.com. Without the breathless, you should do this. They're not looking to get your adrenaline going. Another great source is literally the SEC that just has basic information, how things work, what is asset allocation, what are securities. And so this is another good place to look. Nothing is being sold and no emotions are being triggered. It's just great basic information. If you want to invest, or not invest, but save money in FDIC insured accounts that are optimized for the highest current interest rate, these are two services, Max My Interest and Flourish Cash, that regular retail people can sign up for an account. You put your money in, it will move your money. So say Citizens Bank currently has the highest interest rate. It'll move your balance into Citizens. 3 weeks from now, another bank has the highest interest. TD Bank has the highest interest rate. It automatically moves your money over into that higher interest rate. So it manages it. You don't have to pay attention to it. You can look at your dashboard. Anytime you need this money, your account is attached to your checking account. You can transfer money back and forth. So Flourish works the same way. Pick the one you like, where you like the dashboard the best. If you're interested in looking at zero interest balance transfer card offers or any kind of credit card offer, the places to look, bankrate.com, and I like Bankrate. They are a product marketplace, so they're there to sell. Don't click on anything and you're going to get a phone call. But you can look at all of the 0% interest balance transfer cards, and they're all presented in exactly the same format. So you can make apples to apples comparisons. Look at the fees, look at any restrictions, look at anything you need to know. What credit score do you need to qualify for the card? Very, very simple to shop. But they rate the best cards, so does NerdWallet. And if you're going to apply for one, it might make sense to read both of these sources of information to make a fully informed decision. And then these are the money spending trackers. Good Budget is another one that I talk about all the time. And the whole idea is just to make you mindful of your spending triggers, your habits, where the money goes that seems to disappear out of our wallets. And that level of mindfulness helps us feel more in control and much more calm about our finances. So that is, I'm going to leave this up since these are my resources. And I'm happy to take some questions now if we have any.
All right, sounds good. Thank you, Anthea, for that very helpful, resourceful, and reassuring presentation. I do see one question here, and that question is, what are the consequences of closing the higher interest cards?
So I'm glad you asked that. Closing the cards. So I mentioned the credit utilization ratio before. That's how much of your credit or do you habitually use? And if you use more than 50%, It weighs on your credit score. If you close say you zero out one of your high interest cards and you close it, that credit limit gets removed from your record. And so if you're using other cards more heavily, you could go over that 50% and it could depress your credit score. In fact, initially, anytime you close a card, there's a temporary dip in your credit score. And it's because of that. The other thing to know, another element of our credit scores is how old that credit card is. So having a very long credit history, and I've got a card, I got my first card in 87. That's a long history. If I were to close it, losing that history would make a 10% dip in my credit score. Now, over time, it comes back. So you can do this if you're not about to apply for a loan, you're not about to negotiate a new cell phone plan, you're not going to go lease a car. You can do this because, as I said, it will right itself over time, but you have to be aware of the impact, even though it's temporary.
Great, thank you, Anthea. Does anybody else have any questions? You're more than, okay, so I've got another question here. So much closer to thinking about possibility of retirement now versus getting through last two volatility events you mentioned earlier. Same strategy also if holding several different retirement funds at one institution, if freaking out, move all to money market or the like.
So here's my thought on that. And again, I don't know this individual's timing for retirement. If you're a couple years out, the markets are down now. And if you move the money into the money market, all of it, you lock in those losses. If you leave it alone, there is a chance, the tariff talks go away because whatever was behind that was achieved and the market will rally. You do not want to miss that rally. And I can understand the instinctual urge to go to 100% cash and just sit there. But I would encourage you not to do that. And what I have encouraged people to do, because I've been counseling people to retire through the pandemic, where we had a foreshortened experience of this market drama. And what I told them to do instead is to build up cash on the outside of their retirement accounts, meaning start socking money in the bank. And gave them a goal, said, you know what? I want you to really aggressively save. And you're going to retire in 2 years. I want you to have at least a year's worth of spending needs in savings. We'll talk about deploying that to CDs, bank savings, floating rate treasuries, so you've got some yield on it. But that will give you the ability to retire and at least have that much runway in a couple of years. So that would be my counsel. Build up your cash savings outside of your retirement accounts, and we'll wait and hope for this volatility to go away.
Fantastic. Another question. So with rising inflation and potential market volatility, how can I adjust my financial plan to safeguard against these risks while still pursuing growth? Are there specific steps I should take to balance risk and opportunity in my portfolio?
So this sounds like somebody, if you're still tilted toward growth, who's still working. This is the greatest thing that happened to you. If you were still working, I wish I were this smart when I was young. If you're contributing to a 401k, consider the market on sale. And you should be doing the happy dance, if this lasts for a full calendar quarter, because your 401k investment will be invested at a much lower rate than it was 6 months ago when the market was very high. In fact, valuations for stocks were considered very high. So if you're still in the accumulation phase, this is working for you. This is like a huge sale at Macy's. And I would just, load up and wait. It's if you are within striking distance of stopping your paycheck, retiring. Maybe you intended to retire at 67, but not take Social Security until 70. Very common strategy. This feels a little bit more precarious. You can still do it if you have adequate cash savings so that you are not having to sell equity holdings that are presently, down quite a bit. Okay.
All right. So the last question here is, what would you consider a safe allocation, stocks, bonds, cash for retired people in their 70s?
So for retired people in their 70s, and if you're in your 70s, I hope you're planning to live until 90, right? So you still have 20 years. You don't want to all be in all cash because there's the potential for inflation to just eat you alive, right? Your money won't keep up. So if you're in your 70s planning for 20 years, you still want to have money in stocks. A lot of it depends on what sources of income do you have. Are you somebody who is reliant solely on these investment accounts plus Social Security? How much of your monthly expenses does Social Security cost or cover? How much do you need to pull out of your investments? If you're dependent on these portfolios to cover your expenses, you're going to be more conservative. And you might at this point, you might want to be in a balanced portfolio, equal stocks and bonds. If you're less reliant on money from the portfolios, and there are many people where this is true, they have a pension, they have Social Security. Sometimes they, maybe they get royalties, maybe they have a small part-time job. So they're taking very little out of these portfolios. You could afford to have more stock exposure. Maybe you're 60-40 or a little bit higher because you're not going to take the money out. And yes, this feels uncomfortable to have so much volatility, but you're not dependent on this account. So you can let it sit and hopefully come back to former levels.